This is September 30th, 2020. I have in my studio Charles Nenner from the Netherlands, and he's one of my, I'm a great fan of Charles, so I get his research, he sends us, and I follow him. I've been following him for years and years, and we have him here to discuss what's going on in the marketplace. So I know that you've sent out research. I know that you've been very, very concerned about what's going to happen in the economy. In your research and following your cycles, Charles, what do you see happening in the next short term, maybe in the next 3 to 4 months?
Well, the market can try to test the highs. I mean, I talk to equity markets one more time till the end of November, but the whole thing should come down for the next 2 years. So I'm very, very cautious about it. I don't own much stocks anymore. The place where we are most of the time is in the gold market. That's a very simple market, and interest rates hit a low, so we are short on bonds, and we got everybody out of bond funds because you know, if interest rates go up, the bonds are going to lose the value. So it's difficult where to be in where to invest in if you're in the financial markets, but you have to be very careful.
Well, you sent out your Sunday charts. Thank you very, very much for your research. It showed that it showed on your Dow chart, and I wish I could put this up onto the screen. It showed the spring fall, and then you show in the next, really, it looks like it's fairly imminent, a drop in the Dow on your charts as well. You've often talked about the 5,000 on the Dow. Is this the start of that?
Well, the start maybe we have seen already. We combined it, I think also Sunday, with the daily cycles. So what it said, the daily cycles are turning up, which was Monday. That's why we have this rally. And I don't know exactly until which day and level it's going to reach. As you know, is that the whole theory is based on that things happen not at random. So they happen at certain dates where we can calculate, and they go to certain levels. Excuse me. So I don't have it really ready now what the level is. I think we could test the highs one more time on the markets, not on the NASDAQ, I think, but maybe on the Dow. We have the Dow 5,000 already for many years. It's based on the same system. It's the same thing as that you shoot a bullet in the air with a certain momentum, and then you can calculate, if you paid attention in school, I didn't too much, how high it's going and how long it stays in the air. And that's the same with markets. A market goes up and down with a certain momentum, and then you can calculate how high and low it goes. So if I project from the last low, then for years already said has to go to 5,000. Now it seemed very strange, but now, you know, you never know what happens with the virus. So maybe we can imagine that things are going to turn very bad and we go to 5,000. But again, I tell people, 5,000 where we were in the mid-90s when Clinton was there, and there was still a nice atmosphere and we had a life. So it's not going to be the end of the world. It is if you're on the wrong side of the market.
Well, of course, the markets cycle. They go up and they come down. Our life goes on regardless of what goes on. I love your saying that if you know winter is coming, you can get a winter coat. And of course, that's just forewarning.
You can't change the cycle, but if you know what's happening, you don't have to go under with the majority of the people. So that's why I come with this interpretation of how it really works. It's very hard. For many years, I'm doing this. As you know, I had a whole career in Goldman Sachs. And when you're at Goldman Sachs, everybody says, oh, yeah, that's right. But once you're out of Goldman Sachs, it says, what is going on over here? So the media are just making up so many stories, and they always want to know why something happens, and they don't want to know when something happens. So I wrote this piece about the black swan theory that says, at least the guy who wrote it, he says that, you know, something is going to trigger a sell-off, but we don't know what it is. And I wrote, instead of trying to figure out why it is, don't you want to know when it is? But nobody's busy with calculating theories to know when it is. They all want to know why it is. And that's why people are conditioned to understand why something happens, but that doesn't help them save their money.
Well, it's interesting because I've been following your research for many, many years, and I'm starting to get an understanding, much, much greater understanding, and that these cycles seem like they keep repeating over and over and over again. in my little world, in a real estate cycle, we've got cycles going back to pre-revolution. It seems like they keep repeating every 18 and a half years. They just keep repeating. And of course, now when we talk about assets, each one of your assets has kind of its own cyclical life, does it not?
Yeah, but in order for real estate, you really have to know the cycle in interest rates and the mortgage rates, because that's really important for real estate. Now, something extra happened over here, because I'm talking from Europe. A lot of people who owned a lot of malls, and they just desolate. I mean, people are not there anymore. A lot of people work from home. Office buildings are going to be totally empty. I don't know if people go back going there. So what we thought being safe, being in malls and office centers, is now a very bad investment. So you have to understand the whole picture in order to be on the safe side.
Well, of course, and you were promoting the fact that you thought to be safe, you would go to small units that you
Right.
could rent. And of course, this is a basic shelter. It's about as conservative as you can. And of course, we have the same problem. My investors, you know, I have two investors. I have those starting out, and I have my age. They're all baby boomers, and of course, they want income. And I've been talking to them about bonds. And of course, I think bonds is something, an asset class that you're concerned a little bit about. And on your research, again, you can see that the bonds seem like they're bottoming, and then they're starting to tick up a little bit. So you see the Dow coming down and bonds going up. Maybe there's an event coming on, but there is, you've been saying over and over again, the risk that there is in bonds. Of course, we're at a 5,000-year low interest rates. I would guess that we're probably not going down much lower from where we are already. And of course, once they start going up, that's very, very difficult for a bond fund for sure. And like you say, if you see malls and office buildings that are going to be shuttered and the business slows down, we also have credit risk in the bonds, do we not? I mean, people could default.
Definitely. And I see these bonds go down 30, 40% in half a year or so. So that's where most of the money is in the US, in bond markets, not in equity markets. But, you know, we have some problems now that it seems, I heard it, I'm not sure, that some people have some protection that if they cannot pay the rent, then the person who rents out cannot just foreclose or cannot put them on the street. So the politicians can make certain rules to protect the small people that are in your small apartments, and then you cannot collect the rent. So anything can happen.
Anything can happen. We have not seen that here. Of course, in our markets, one of the things with real estate, of course, as you've already alluded to, it's a regional market. So some regions do much better than others. There's demographics in play. There's movement, you know, where people go where the economy is very, very good. And of course, that makes a difference. What I have with my baby boomers, they all need income. And of course, there's such a risk in bonds. We've been moving into small units that they can pick up their income. They can pick up 2 or 3 times the return on a small unit, and of course we grow that here. So that's been very, very good. But I guess I'm concerned. You still see problems for the bond market, and of course I think Europe's even in worse shape. I think the sovereign debt problem in Europe is going to be quite substantial. What's your thoughts?
But the good thing about Europe is that if they issue bonds over here, 99% is bought by the local people. And the US, I think it's 40%, the rest is China or Japan, or, you know, so we can do it to ourselves, but the United States has to rely on foreign entities, and that's very dangerous.
It is dangerous, but for those people holding those bonds, it could be really, really dangerous, could it not?
Very, very dangerous, very dangerous. But they have seen a bull market of 35 years, and everybody's asleep, and they don't realize even bonds can go down. And it's like a cycle. If you look at my work, it's like a cycle. It's almost time for the bonds to go down and interest rates to go up.
Well, we've talked about that interest rate cycle. It's a pretty long cycle, is it not? I think it's about 70 years long, is it? It's 35
Yes.
up and 35 down?
Yeah, more or less. Depends, plus minus a couple of years.
And you can see that just if you just look at the interest rates when Paul Volcker got in and he broke inflation. I mean, there is as strong a spike as you could possibly see. So that's certainly a great starting point, and you can just see interest rates drop from there. And you're right, we've been spoiled for 35 years. Rates have gone down. I don't know what
Right.
people are going to do when rates start heading back up.
I have no clue. I mean, you know, they tried to keep this economy going as long as they could. Every Fed president says, okay, I have some more tricks. So I will not go into history that the crash happened in my time. And they just push it forwards until there's nothing they can do anymore.
So speaking of that, we looked at your charts, and you've got gold bottoming. You sent out your chart on Sunday, and it is clear as a bell. You could see where it started to drop, and it looks like it bottoms. I think next week. Is that correct?
Next week, yeah, next week. And I wrote that we went out just below 2100, and we bought back around 1850 because that was the price target. And it probably started already, the up move. But like I said, the problem is that people who don't really watch my work, if they hear us, they says, oh, I'm going to buy gold for the long term. And then what happens is, if it goes down $200, $300, they get scared and they sell out. And then we usually, you know, we're out when the cycle says it's stopping, we have to go out and we buy back at the bottom. But then if I say buy, they lost so much money, they will not buy anymore. So also always on the wrong side of the market. So I want to be very careful. Yeah, I say gold is a good investment, but if you can watch my cycles, because you don't want to lose $200, $300 and get emotionally upset before it goes back up again.
Well, of course, and that's one of the problems when you have a liquid marketplace, is that people can get panic and they can just push that button and it's gone. And they don't really take a really long view. You have been saying this for years. I think really since 2011, 2012, 2013,
Correct.
you've had a $2,500 target on gold, have you not?
Yeah, that's still the target. But it could come higher because the cycle's actually up for a couple of more years. So it depends how fast we get to 2,500. If we would be there in half a year, I probably get higher price targets. If it takes 2-3 years, then the cycle is stopping and that's it.
So what do you think about silver as well as gold? It seems like the ratio between silver and gold is out of whack at the moment. It seems like silver might actually be even a better investment.
Yes, it's usually the small investor goes into silver, and gold did very well because the big funds and the central banks all over the world are buying gold, not silver. And once everybody gets very excited again, then every I won't say idiot, I don't know what to call him, every small investor will go, and gold is too expensive, so he's going to buy silver. That's usually what happens. So the moment that silver is catching up with gold, usually it's almost over.
So do you think that's just a shift from financial assets like stocks and bonds into real assets like gold and real estate that's coming? Do you see like inflation coming on top of this, Charles?
No, but I have big investors who deal with physical gold. They tell me how difficult it is to transport it, how much taxes they have to pay. Everything is to be under the name because they don't trust the financial system anymore. So they store away gold if they have a lot of money instead of putting the money in the bank.
So if there's financial turmoil, you're suggesting people have physical gold rather than gold funds.
Yeah, but not everybody can do that. I checked it; it's pretty complicated where to store it and how to get there. So for us, you know, average people, the best is just to buy gold, gold mines. Once my cycle's bottom, I buy gold mines. They give a couple of percentage dividend. Nice. And if you're sophisticated, you buy the stock, and then after a while you sell a good call against it, and you made a very nice rate of return.
Well, most of my clients are my age. They're more concerned about capital preservation, and they need income. And of course, when they start to retire, they're really retiring from their work. They're looking for a place that's safe and some place that they can maybe be conservative, still get some income. So gold seems to be like a gold and gold miners. You can pick up a little bit of dividend. Any other ideas? I know we've been talking about bonds. I've been trying to get my clients out of bonds. I think bonds is probably a really bad place for them to be. And going into bonds, of course, though, that leads us back to Deutsche Bank with some of their derivatives and some of the problems that they have. What's your thoughts on Deutsche Bank? I know that's been like a canary in the coal mine for a while.
Yeah, well, it still didn't close below 6, They're very interactive with other banks in Europe. So once they close below 6, the situation is very bad. I just want to mention we do a lot of playing the VIX, and the VIX goes up when the market goes down. Now, people don't like to be short because that's too emotional if it goes against you. But if you do the VIX, you go long. And if you buy it from a low level, especially if you go back, well, like we have a lot of call spreads, you can make amazing returns. You can put it on and for the next half year and just wait and wait and wait. And if the market comes down, you're not going to suffer. And as long as it doesn't come down, you're safe with all your investment on the real estate and whatever you have. So it's a pretty good hedge if you watch the cycles when to go into the VIX.
Well, I've watched you. You've been absolutely amazing. Some of the calls that you have made, I remember you on CNBC in December of 2007, and talking about, I think you almost got the peak of the 2007 market to the day. It was truly amazing. Truly amazing.
It's the computer system is really working very nicely. And it's a system, or it works or it doesn't work. So we get very specific indication. And we tell people, you know, if you look at charlesnenner.com, you can get it for free for months and just watch every day what we say and when it works. And then you take another look at how reality works. For instance, in the time that OPEC was very important and powerful, they had meetings during the weekend. And I always knew what they wanted to decide because I knew what the price would be on Monday. So then you look totally different. Where's the free choice to decide it because the cycles already show if the crude goes up or down. So you start thinking totally different about how financial markets and how actually the world functions.
It's truly amazing because you and I chatted in January and you were talking about the fact that your work was showing that oil was going to go down below $5. Right. And I asked you, how is this possible, Charles? How is this going to get down below $5? And you said, I don't know, but I see it on my chart. And that's the type of things that just absolutely amazes me. Well, we're in the real estate business, and of course, we're in a business of providing income for our clients. You and I once talked, and you said, and the reason I bring this up is that you talk about the VIX. We also talked about if you're concerned that we're perhaps concerned about your real estate portfolio, that you could short housing. You could short some of the housing stocks.
Usually the housing stocks go down before the real estate goes down. The insiders look at the housing stocks and they know what's going on. So that's like a canary, like you said, that shows you what's going to happen to the housing market. So if you're very much afraid, you can always hedge with being on the short side of housing stocks. And watch exactly the charts and the cycles on the housing charts, like Lennar and Toll Brothers and all these, because as long as there's no major cycle over there, you're okay with real estate. Just if it shows these stocks are going to crash, then you can see that the problem is coming.
So we always has some forewarning. If we just pay attention to the marketplaces, we're getting some forewarning on it. We, of course, you know, the regional real estate is a lot different here in the United States because we have 3 major markets that are doing really exceptionally well, and there's a lot of out migration from a lot of the other states in the United States, and we have a lot of movement, and some markets are doing exceptionally well, and others are just doing okay. So I guess when you look at a national basis, it's you can see the cycles a lot better than going on an individual and a regional basis. But we can certainly watch the housing stocks and let us know what's going on with that. So can I segue back into your Dow on the 5,000? You do long-term charts. Do we have a time frame on this, Charles?
About the middle of 2022.
And that's going to be bottom?
Yeah.
5,000? So does your chart show that this is a gradual decline, or are we going to have some kind of event that looks like it's going to precipitate this pretty quickly?
That's a good question. You can call it gradual, but if you, what are we now, late in 2020 already, and if we have 1.5 years, it cannot not be too gradual. Once it starts, it starts. Like you know, I explained about cycles. They don't always work with the facts. They work with interpretation of the facts. So Right now we say, well, it's going to be a V recovery and it's not going to be so bad. But if the cycles turn down, then people are going to be very negative. And then they come up with anything that can bring down the markets, and then it goes.
Well, what's interesting when looking at your research, and I don't mean to keep harping on the fact that of your research, but your research has been absolutely phenomenal. The research you sent out Sunday, you can see the separate asset classes are all working together. You can see how each one is being affected by the other one. You can see that bonds are bottoming. You've got the Dow dropping. It's already peaked, and it looks like the Dow is heading down. At the same time, you can see bonds starting to come up, and you can see gold start coming up. So the other asset classes all are affected by each other, and your work shows how that happens. I'm such a great fan. I look at this and go, wow, that is just truly, truly amazing how it's all interconnected and it all works.
Yeah, that's why I would say everybody, I tell them, why don't you sign up? It's a free sign up. And just get an idea how markets really work. Not what they taught you, not what they tell you on the media, but see how the professionals really approach the market. Not that they know what I know, but at least they do it in a professional way. So if a professional makes a mistake, he can figure out where the mistake was. But if you have no idea what you're doing, you can never better yourself because you don't know where you went wrong.
Right. So if you just pay attention, you can kind of keep yourself out of trouble. So, life is going to continue on. Everyone is going to be just fine. But of course, we have financial assets that cycle. They undulate a little bit. So, and each one of these, one asset is better than another at a certain time.
Right.
So if I can kind of recap, it looks like again the call is bonds are going to be a problem, and we bottom in interest rates. I mean, we're at a 5,000-year low, so it looks like bonds have probably dropped, and there's probably does it look like it's going to be a severe increase on this yes, Charles?
I think we're going to have a liquidity crisis like we had in Italy and Greece. So although the economy is weak, people are afraid to give loans to each other. This is only if you pay a lot of interest, and that's why interests go up, although the economy is very weak.
And of course, we've got the Federal Reserves and the central banks coming in, and they're going to liquefy the markets, I would guess, if we had any kind of problem. So they can affect the short term. You're talking
but not
about
the long
more
term.
than you're
they
thinking
cannot affect the long term. No, they cannot do anything about the long term.
No, I understand. So you're thinking that the long term is probably going to start going up on the back end.
Well, anything can happen. Let's say China really has enough of the United States. They can punish the United States by selling their US bonds, and then interest rates could be at 15%, the 30-year bond. I once calculated that. If you know how much they own of our bonds, so everybody depends on everybody. It depends who's going to give the first sign that I'm going to get you.
Well, then, as an investor in real estate, we should probably take as much long-term money right now as we possibly can then, because rates are heading up from here.
Definitely. Take as many loans as you can. Don't throw it away, but take the loan.
Well, we've got some very, very good markets here that are doing very well, and of course we've got rental increases that keep adding to it. So for my baby boomers, we're probably the safest thing for them to do is to stay out of bonds. If they need income, we can get income through real estate. If they're concerned about their real estate portfolio, they can short a couple indexes. They can short the housing index. They can go long the VIX, I would guess, huh?
Yeah. Don't go short. It's emotionally difficult for people not professionals. Just go long the VIX. Maybe we stay in contact. I will give you the sign when to do it. Let's continue to take a look at the cycles on housing stocks. So we're not going to be surprised. Usually you have a couple of months leeway when housing stocks start going down before real estate is going to suffer. So you know what's going to happen.
Well, we find that real estate sometimes counter-cyclical as well. So when the stock market has trouble, it looks like housing actually picks up. When we had trouble in March and April, our housing just exploded. Our market just been very, very strong. And of course, we're in one of the big markets in the United States, but nonetheless, we've seen housing go. So a little bit of counter-cyclical. So I guess the advice would be stay out of bonds.
Stay out of the stock market.
Stay out of stock market. We're being very, very conservative at this juncture.
If you want to follow me, you can do it nicely in gold and gold stocks, but you really have to follow what we're saying. Again, because this is very volatile gold, and you don't want to be on the wrong side if it goes up and down $300. But then you do very well in the metal markets.
Well, your research and your forecast has just been truly amazing. And if you see gold go $300, you can sell and then buy back and then sell and then buy back. It's been absolutely truly amazing. I mean, your work. I'm just amazed at your work. So Charles, how can people take? We'll certainly put your website on the bottom of any YouTubes that we do. But how can they take advantage of your research?
I think if they go to charlesnenner.com, there is a button that you can ask for a free trial. And then you have a free trial, I think, for 4 weeks. I think you get even the intraday updates. We also have intraday updates. So you say, I want to look at 10 o'clock. Is there anything I should do? What's the level? Where is it going? And then it takes some time to understand how cycles work. So I would not say do something. You really have to watch it for a couple of weeks to know how to use it.
Well, and from research that you sent out, we're going to have a couple of tumultuous 4 or 5 weeks coming at us. So probably a really good time to do that. Yeah. So any other closing thoughts, Charles? Anything that you'd like to say?
No, what I say to everybody, don't underestimate the virus situation. It's much worse than everybody thinks.
Can you say that again, Charles?
Don't underestimate the virus situation.
Oh.
Because it's much worse than everybody thinks.
I'll be darned. Okay, well that's good. That's good news. Or I guess that's good advice. Well, Charles, I want to thank you very, very much for coming on with us today. We'll share this with us, and if we'll certainly add you to our on the bottom of the YouTube that we have your research, Nenner Research, so that they can get hold of you. And I want to thank you very, very much, and wish you a happy holiday.
Thank you very much.
Charles.
See you soon. Bye.
Bye-bye.